Hey, good morning, everybody. Welcome to our Saturday event here. It's September 26th. You got John Hopkins, going to be joined by Tom Bowley in just a couple of minutes for a short squeeze chart list. You know, I said get your favorite beverage. You know, it's 5 o'clock somewhere, right? PM. 5 o'clock in Amsterdam, Barcelona, 6 o'clock in Baghdad. So, you know, we could have people listening from those areas and enjoy your evening beverage. That'd be great. It really is great to have all of you with us today. I know we've got some people who are new to Earnings Beats. Also, some people have been with us since we started. We actually started our business, Tom and I, back in 2004. It's been 16 years, a couple of iterations along the way. The current one, earningsbeats.com, and a lot of focus on earnings and charts that are relative to earnings. It's hard to believe that earnings season is almost upon us. Yeah, another 2-3 weeks, and we'll start getting earnings reports for a Q3. And going to see if companies, meet expectations, beat, come up short, whatever. But it's a time when we get really much more active. We'll have some other events coming up in October, and we actually have an event coming up Monday that is for our members. It's going to be the Q4 market outlook. And I'm sure Tom will mention that. But you can, go to our website, right to the calendar, and you'll see that we post all the events. And we've got a couple of other exciting events coming up in October that we'll be unveiling shortly as well. But for today, we're going to be focusing on short squeeze chart list. This is something relatively new to Earnings Beats that we're finding members are finding quite useful, and I think you're going to find it pretty eye-opening this morning. So I'm going to turn it over to Tom. I want to mention one thing. I'm sure at some point Tom will share with you, but if you go to our website, earningsbeats.com, you'll see webinar special link. Every time we have a webinar, we offer a special where you can save a ton of money. So make sure you check that out. There's a lot of good benefits with becoming an annual member. And if you aren't a paying subscriber now, and you want to attend Monday's Q4 market outlook, which would be a good one, you can also sign up for a no-cost trial on the website. Just go to the membership options, and for 30 days, you can give us a look and see if we're a good fit for you, and that'll get you a seat into Monday, plus the other events we've got coming up during October, including our earnings season, Q3 earnings season webinar on the 19th of October. All right, this session is being recorded like every webinar we have, and our members have access to every webinar that we do, and everybody who attends today will get a copy of the recording of this webinar, time-stamped, courtesy of Abby, who's going to make sure everybody gets a copy, and certainly hope you enjoy it. Okay, with that in mind, I'm going to go ahead and see if Mr. Bowley's in the house. You there, Tom?
I'm here. I'm ready to go.
I'm always glad to hear that you're there. I'm waiting for the day when I'm waiting for the day when there's silence and I got to move into action.
Yeah, that might be a little tough since I have all the information here at my fingertips.
Okay, we've got a great crowd. I'm telling you, it's a great crowd for Saturday. Appreciate everybody taking the time to come in, and Tom's going to take it away.
All right. Yeah, I think we've got a really interesting event today. Short squeeze is just kind of a small niche of the market, and some of what we look at in terms of, I always talk about short-term market inefficiencies. Long-term prices go where they're supposed to go based on earnings, based on the economy, based on relative, performance versus other companies. I mean, in time, things get kind of filtered out the way they're supposed to. The great companies get valued higher, and the lesser companies get valued, worse or lower. But in the short term, there's a lot of things that happen in the stock market, a lot of inefficiencies that take place. And I think short squeeze is probably one of those areas where, a company can do extremely well because of short-term issues and may not be a great company, but it's just short-term pressures that are placed on traders to, in many cases, have to buy to avoid painful losses that just keep growing and growing and growing. And that's really what a short squeeze is all about. So I'm going to get into all that in just a couple of minutes. I do have a couple of announcements that I want to get into. But let's go ahead first, and we'll pull up that agenda for today and just talk about some of the things that I think are important relating to the short squeeze chart list. We'll start off, we're kind of going through the introduction right now. Got a couple of announcements I want to make, and then we're going to get into the basics of the short squeeze. Just hopefully everyone will understand the short squeeze. If you already understand it, know it, then just a little refresher. I'm going to go through some recent examples. These are stocks that either I've written about, I've talked about on shows. We've provided in our Earnings Beats Digest, which is our free newsletter. We occasionally have provided those to our earningsbeats.com community. So we'll go through some of those recent examples. I'm going to tell you some of the stocks on the list, on our short squeeze chart list right now, that I believe are still current candidates, either that they, look great, that their relative strength has been improving and so forth, or maybe they've already made the breakout and we are in the midst of a short squeeze. So I'll go through some of those. Analyzing the short squeeze chart list. We have a chart list. We do a lot of research, and I like to think of Earnings Beats. Some services just fire out stock trades. That's all they do. Here, this stock looks great. The MACD or the PPO is doing this. Buy it. That's not really what we're all about. We certainly give you a lot of trading candidates, but we're more about education, and we're more about research. My background as a former practicing CPA was really on the fundamental side, and I had a passion for technical. So our service really combines both. We have a strong earnings chart list. We have a lot of different features in our service. It's very comprehensive, and I think anybody who's been a member, if you want to become a member and check it out, I think you're going to find there's a lot of really good information, a lot of really good research that we do to try to help our members outperform the benchmark S&P 500. That's really our goal in just about everything we do. Some of it's based on education, some of it's based on our portfolios, but really the overall goal is to try to help everyone outperform the S&P 500. Because if you can't, then just put your money in the spider and just go do your thing. I mean, it doesn't make sense to get involved in the stock market, in individual stocks, in the ETFs, whatever, if you can't beat the S&P 500. I mean, you really need to be serious about that and take an honest look at your, how you do in the market. And if you're not doing well, just put your money in the spider. Seriously. I mean, that's not great for our business, but that's what you should be doing. I think our business will help teach you beat the S&P 500. But if you're still unable to, put your money in the spider and go enjoy life, whatever that those other things are that you like to do. But I'll go through this short squeeze chart list because this is one of those research areas of our website, of our service, that I think can really help, especially if you like to trade. I would not buy and hold long-term companies that are on the short squeeze chart list. Many of these companies are being shorted for a very good reason. They're not great companies. They have a lot of fundamental flaws. That's why many hedge funds and so forth are taking huge short position against them. But just like the overall market, we have so many portfolio managers that can't outperform the S&P 500. Just because they buy stocks doesn't mean those are great stocks. Well, just because hedge fund managers and others short stocks doesn't mean they're bad stocks. Some do eventually break out and go against the masses. And when they start to go against the masses, that's when you want to be involved. But anyway, I'll go through some of that later. And then I'll show you how you can download the chart list. One thing we promised everybody that attends today, anybody listening on a recording, we'll make sure you get a copy of the of the short squeeze chart list. And when I say a copy, if you're a Stock Charts member, if you're an extra or a pro member or above, we'll give you a link and a password. You can download this thing right into your account. Now, the short squeeze chart list does change every once in a while, but at least it'll give you a sense of what we do in terms of the short squeeze. So we'll make that available to everyone. Now, if you're not a Stock Charts member, extra member, or a pro member, let's say you just have a basic service, or you're not even a Stock Charts member at all, you can still view the chart list. You'll be able to go through and view the stocks one at a time, and there's 72 on the list, so you can go through and see what you like, what you don't like, or whatever. You still be able to view it. You just won't be able to save it. You won't be able to download it because either you've got an account at Stock Charts that's a basic where you can't download chart lists from someone else, or if you're not a member, obviously you can't download chart lists. You don't have an account to save it in. So anyway, we'll go through all that. So I'm going to get started here. Let's go into the announcements. John mentioned that we have a webinar special, and we do. We always have webinar specials. So that if you do like what you hear and you decide to give us a shot, we'll make sure that you have an opportunity to get a really good deal on a membership. So our webinar special runs through Monday, September 28th. We go through all the different items here. And by the way, if you're on our website, just click on the webinar special at the top. It'll bring you to this page. But you can go through our portfolios. Our portfolios have been absolutely awesome. And I'm not saying that just because there are portfolios. I mean, when you've got 80% of mutual funds that can't beat the S&P 500, and we've got our model portfolio now that's up 141 or 142% in 22 months, while the S&P 500 is up 21%, I think that's pretty strong outperformance. And, honestly, it's a pretty simple strategy. You go through, you equal weight 10 leading stocks in 10 leading industry groups and hold them for 3 months. And then you do it again. Hold them for 3 months. You do it again. We have these portfolios where we announce the stocks, the top 10 stocks in each of our portfolios. We do those February 19th, May 19th, August 19th, November 19th. So the last one was August 19th. I can tell you right now, our model portfolio in 5 weeks of this quarter, in 5 weeks, we're already 9 percentage points ahead of the S&P 500. And again, it's not really any big secret. It's just sticking with leading stocks and leading industry groups. Anyhow, you can go through and you can take a look what you get with the membership. All these chart lists. I told you the short squeeze chart list, but all of these chart lists we allow our members to download. We have a page on our website. We do all the research. Strong earnings, you want to know if your company fits into our strong earnings chart list, because these are stocks that outperform the S&P 500. If you want to know, well, we have the chart list. You can download it right into your account at Stock Charts. If you're not a member at Earnings Beats or at Stock Charts, take out a 30-day free trial at both. We charge you $7, but we'll refund it within a week. It's just with our system, we have to have the credit card information. So that's our way of doing a free 30-day trial. But anyhow, if you're not a member to either, try it for 30 days. This would be a great time. And I'll tell you some other things that we're going to be doing, which I think just adds to the value. And when you have a free trial, you really don't have to provide much value. I mean, to be honest, it's free. But we have scanning strategies. So you literally can copy our scans, the scan syntax, go right into the Stock Chart scan engine, drop the syntax in, and run scans against these chart lists. So easy. Now, the industry group relative strength chart list, this is a group that we only send to our annual members, because once you have this chart list, it doesn't change. All these others, we're constantly updating and we're sending new chart lists to our members. This one is one that just stays the same. And it's my go-to in terms of trying to find strength, industry group strength. When I start talking about strong leading stocks within strong leading industry groups, well, I find the industry group simply by reviewing this chart list. It's just a very simple way to find out what's going on. So because you don't need to update it regularly, we do ask that you commit to us for an annual membership. Then we got a ton of webinars. This doesn't even cover all the webinars, but these are a few of the big ones that we do. But the whole idea here is if you become a member of a paid or a trial member and you just start paying every month, you're going to get charged $97 a month. So through 12 months, it's gonna be $1,164. And then if you add on a 13th month, it'll be $1,261 for 13 months, paying the monthly fee. If you sign up under this annual special, then you'll pay $697 for the whole 13 months. You can see that's a pretty big savings from $1,261 down to $697. So if you like what you see here, absolutely take us up on our annual. I know a lot of services, when you commit to an annual, you get 1 month free or something. Ours is almost 50% off. And we get the question sometimes, what if I want to cancel after a month after I have an annual? Well, we're not going to refund because we're already giving you 50% off of the membership. I mean, if we did that, who in the heck would ever sign up for a monthly, So we try to give you a really good deal. That's the point here. So check out this webinar special at any point, through Monday, September 28th. And if you really like what you see here, I would encourage you to sign up for that annual membership. All right. I want to make 2 big announcements today. I was teasing everyone, I don't know, maybe 2 weeks ago, talking about an ETF service or, some announcements coming up about ETFs. I just want to let everyone know we are going to introduce a new ETF service. We are in the final stages of putting it together. We're going to have an ETF, a strong ETF chart list. So instead of strong earnings chart list, we're going to have a strong ETF chart list. And in that ETF chart list, we are going to be doing all the research in terms of technically finding which ETFs are doing well. We're going to have those in a chart list. They're going to be updated periodically, probably maybe every 2 weeks, probably at least every month we'll update it. I'm envisioning a periodic ETF report that will come out to our members. Because ETFs are a little bit, I look at them as more buy and hold. They're not really buy and hold. I mean, you can trade ETFs, but not like individual stocks where we're trying to hit a short squeeze for a week or something like that, or a few days. I think we'll probably do like a monthly ETF report would be my guess. But then the biggie is we are looking at doing a model ETF portfolio. And in this model ETF portfolio, we will provide, I don't know how many ETFs. It's not going to be like the stock, the model portfolio that we do for individual stocks where it's 10 stocks. I'm not necessarily saying it's going to be 10 ETFs, and they may not even be equal weighted. The ETFs, it might be, okay, we want to put 30% in this ETF. We want to put 25% in this ETF, 15 in this, and 10 in this. But however, I didn't add it up in my head, but whatever adds up to 100%. But the real kicker is that when you pull up the ETF, maybe I can show it to you in a little bit later. But when you pull up the ETF in our chart list, there are going to be 2 boxes. One is going to tell you that ETF's breakdown by sector. So you'll know. And the whole thing about this with ETFs is a lot of people will, write to me or ask me questions about ETFs. What do you think about this ETF? Isn't it a buy because it goes above this level? Well, that's part of it. That's the technical side of it. But do you know what the ETF owns? I always, when I think ETF, I think know what you own. If you're going to buy an ETF, know what's in it. If you got an ETF and 30% of it's in energy, I'm not going to be a fan. I don't like energy. And without these breakdowns showing percentage in various sectors, you don't really know what you own. So the whole idea here is to give you a chart list of ETFs that are some of the best technical, have some of the best technical pictures. And I envision showing the ETF relative to the S&P 500 over maybe a 3-year weekly period. So we're not just looking at an ETF that's been doing well for the last 3 months. About that time just falls apart again. We want ETFs that show pretty good long-term track records. And then in addition to showing you the breakdown by sector, we're also going to give you the top 10 holdings of each of these ETFs and how much percentage-wise that they make up of that ETF. So I think it's going to be a lot more information than most people get or do, when they buy an ETF. So I think it'll be another research product that we have that I think will really help you, especially if you're looking to invest in ETFs, if that's something that you're interested in. And our goal is going to be to try to outperform the S&P 500 with these ETFs. So, if I'm aggressive, if I'm thinking growth stocks are going to be leading and our model portfolio is, loaded with growth stocks, our model ETF portfolio is probably going to be in ETFs that have kind of this growth stock vibe to it. We want to be able to benefit from what's working in the market. But anyway, there'll be more coming out about this, but I think probably in about maybe 3 weeks, because we're still trying to work out some things on this. But I would say maybe in about 3 weeks, 3.5 weeks, something like that, we will have an event where we will be selecting our first model ETF portfolio. So keep that in mind. Second thing I want to announce is that I'm going to be offering to our members, and this is probably only going to be for annual members as well, because this is proprietary information. But I'm going to be putting together a big picture chart list. And in the big picture chart list are the things that I look at in evaluating the market. I've written a lot of articles. Back in March 13th, I think it was, I said, hey, we're still in a secular bull market. And that was when the sky was falling. And believe me, I got a lot of emails back then. People were like, you're crazy. This isn't a bull. Look at what's happening in the market. This isn't a bull market. And I tried to explain my rationale, the accumulation distribution, all these things that were taking place, the rotation. We weren't rotating towards safety, and there were just a lot of things. You have to look at the sectors. How are the sectors performing relative to the S&P 500? Anyway, I'm going to put together this big picture chart list that's going to be available for you to download right into your Stock Charts account. And I'm envisioning 20 to 30 charts, something like that. But it'll include all the different things I look at in evaluating the market, including the sentiment charts, the volatility index, the things that I wrote about September 2nd or September 3rd. I said there was a big warning. Sentiment we're saying we're in trouble. Right then, we pulled back 10% on the S&P 500 and 15% on the NASDAQ. Those are going to be available in this chart list. So again, our mission is to educate. A lot of our competition out there just wants to fire out stock picks, which we have some of that for sure. But we're not registered investment advisors. I think it's irresponsible for me just to tell everybody in our membership, hey, go buy Moderna. This is a highly volatile biotech stock. Some of our members might love it. Others probably wouldn't sleep at night if they woke up next morning and the stock was down 15%, which is customary for some of these highly volatile biotech stocks. So I don't understand how, without getting a risk profile of all your members, I don't know how you can really fire off. I always worried about that. We used to, provide daily, or not daily, but we used to provide stock alerts. And, I give you a lot of information. You can do with it what you want. I try to be really upfront about how volatile some of these potential trades are. But we've kind of gotten out of that business of just giving trades and saying, here, buy this, sell it if it gets this, because our membership is so varied in terms of risk tolerance. One trade, it's like, one size fits all. With trades, that's not the case. We shouldn't be suggesting, someone who's, living on fixed income has no business trading small biotech stocks. But others who are incredibly aggressive might say, hey, yeah, throw me, if you like this chart setting up, throw me the stock. So we give all that information, but we don't want to do it in form of alerts. Anyhow, that's kind of how our business has shifted. I'm really focused on the educational side. I want our members to learn and profit from that education. I paid plenty of tuition in the stock market. So, all right. Anyhow, that's the two big announcements: the ETF model ETF portfolio and the overall ETF service. I do want to say what we are anticipating is this is going to appeal to different folks. A lot of people who like to just be involved in ETFs probably don't really get much out of our service right now. And those who want individual stocks probably could care less about the ETFs. So we're probably going to have two separate services, but anybody who wants both will end up bundling. But what I envision for the balance of 2020 is that we're just going to include it as part of your service. So for the next 3 months, you're going to have all the services under the current structure. And then beginning in 2021, we will probably break the two services out and then give you a really good price on a bundle of the two services if they both are appealing to you. And you'll have, like I said, plenty of time to check that out. So that's the big ETF service announcement. And then, of course, the big picture chart list, another feature that we're going to be offering. I think you all really appreciate that one. But that, again, will be for our annual members. There's got to be a commitment. There's a lot of experience, a lot of, like I said, tuition that I've paid over the years learning all these things. To give it away to somebody who comes in for a free trial and leaves, just, I don't know, I feel like you got to be a little more committed to us for that. Anyhow, let's move on. Basics of the short squeeze. Let's get this thing started here. If you go over to the glossary, this is right off of Chart School. If you go into the glossary, a lot of different things. If you don't understand, go in here. But short selling in general, if you just read through this, the process of selling a stock is that with the hope of buying it back at a lower price. I mean, that's the whole idea of a short sale, is you're selling first. If you're not familiar with short selling, you just invest in the market, you buy, and then after it goes up higher, at some point down the road, you hope to sell at a higher price. Short selling is just opposite. And you might say, well, how do you sell something you don't own? You borrow it. That's how. So short sellers are bearish and believe the price will decline. So you're selling first, you're hoping the price goes down, and then you're going to buy it at the lower price. So you're just doing it in reverse. Short selling involves borrowing stock from your broker to sell short, and you have to use margin to finance it. You need a margin account at your broker in order to be able to short stocks. If the price of the stock in question keeps going higher, though, if it advances too far, then the short seller is going to be notified with a margin call and may have to put up more money because you're borrowing. Okay, some people selling short don't understand all the ramifications. Also, if you're shorting a stock that pays a dividend, you have to pay the dividend. You don't get the dividend. You don't own the stock. Remember, you're on the wrong side you're on the other side of the equation. So you got to pay dividends. So if it's a dividend paying stock, be aware of that. But a short squeeze, and this is what we're going to talk about a lot today. Short squeeze occurs when the price advances so fast that short sellers are forced to cover their positions. So, one analogy, and I have a couple analogies. One analogy would be, your neighbor. I always use the analogy where your neighbor's got this, wonderful car. It's a, Lamborghini. And, you don't see those every day, but your neighbor's got one. And for whatever reason, you think the price of Lamborghinis is going to go down and you want to profit from it. If you thought it was going to go up, you'd go buy a Lamborghini and then you just sell it when it went up. But you think Lamborghini is going to go down. So you go over to your neighbor and you're like, hey, can I borrow your Lamborghini for a few months or maybe a few weeks? I don't know. Can I borrow it? Sure. Well, probably you don't have a neighbor that's going to let you borrow their Lamborghini, but just bear with me. So he gives you the keys, he gives you the title, he gives you everything, and you're borrowing that Lamborghini. Well, you decide, I'm going to sell this Lamborghini, and then later I'm going to buy it back and I'll return it to him. But for now, I'm going to go ahead and sell this Lamborghini because I know, right now I can sell it for 150 grand, but it's only going to be worth 100 grand in 6 months. So you sell it. You get the $150,000, and now you're holding this. You're waiting to see what the price of Lamborghini does. Lamborghini goes down to 100,000. You buy it back. You buy that Lamborghini back. You just made 50 grand. You sold it for 150. You bought it back for 100 grand, and now you return the Lamborghini to your neighbor. You might have to pay your neighbor a little interest because you borrowed it for a while. That's how short selling works. Now, a short squeeze, if you want an analogy for a short squeeze, is you put all those Lamborghini owners that just borrowed their neighbor's car, you put them in a room with about 10,000 people, and you put a little small door over in the corner, and then you set the room on fire. And you say, okay, Lamborghini prices just went up 10, 20%, and we think they're going to go up even higher. And by the way, you need to exit. And so all of these folks are in this room, and they're all trying to get out that little door. And in addition to that, you've got other people that are buying the Lamborghinis, in addition to those that shorted and borrowed those Lamborghinis. So you got everybody heading, to buy Lamborghinis. Imagine what that does to the price of the Lamborghini. So that's the analogy. I don't know how good that analogy was, but literally being in a room that's on fire and having a room or an exit in the corner and everybody trying to stampede out is literally what can happen with a big short squeeze. Everybody sees the price going up. They all have it's borrowed. They're borrowing money, and as prices go up, their losses are unlimited, right? I mean, if you sell at $10 and the stock goes to $20, if you sold, say $1,000 worth, you have to buy it back for $2,000. If it goes to 30, you buy it back for 3,000. If it goes to 100, you buy it back for 10,000. If it goes to 1,000, you buy it back for 100,000. I mean, the whole idea here is that you've got to buy those shares back, and as prices go up and the demand is picking up from others, the demand actually starts to multiply because of all the shorts that have to get out, that have to squeeze through that door because of the fire. And so as a result, you get these short squeezes. So that's the whole idea of this short squeeze chart list is we want to do our research. We want to know which companies have traders that are all packed in this little room that might have to squeeze out that door at some point. And then we sit back and we wait. Does it mean that every time a stock is heavily shorted, we just go out and we buy it? No. In fact, I would say adamantly, do not do that. Many of those stocks are heavily shorted for a reason. They keep going lower and lower and lower. It's the small percentage that begin to break out, that begin to show relative strength, that begin to see their volumes pick up. Those are the ones, and they can explode to the upside. We're going to go through some of those right now. So let's talk a little bit about some recent examples. Now I'm going to show you, I know those of you who are in here who are not members of Earnings Beats either signed up for our Earnings Beats Digest, which is our free newsletter, in order to register for this event, or if you came directly into the room, we'll add you to the Earnings Beats Digest based on the email that you've given us. And you'll begin to get our Earnings Beats Digest newsletter 3 times a week. It's free, no credit card, unsubscribe at any time. It's really just our way of trying to, give back to the community a little bit and to help educate. And then if you learn our style and you really like what we're doing, then it might make sense to try our service. So that's the whole idea. We want more and more folks to understand how we approach the market, and I think it will really help in your trading / investing as you go forward. But looking at this chart, this is GME. Now I'm going to go back and show you first. This was the Earnings Beats Digest chart that went out. This was the September 2nd version of GME, and I wrote this and I said it could be in the midst of the mother of all short squeezes. And what I was really looking for was to see this stock get above $8. Now, right after I posted this, they had their earnings coming up, and after earnings, the stock pulled back. I'll show you. That was when we were up right around here. The earnings came out, the stock pulled back to its 20-day, also really close to this breakout level around $6. And from there, you can see it just exploded. But look at the volume. Now, look at that volume compared to every other volume throughout the year, all the other daily volumes. I'd say that that's some pretty heavy volume. And you know what's going on here? The visual for me is all of the traders trying to get out of that room and squeeze out that door. And as a result, the stock price has gone from 5.5 back in the end of August to over 11. It doubled in 3 weeks. That is a short squeeze. And again, September 2nd, when we started to make this move, this is when I wrote, in that EB Digest that, hey, this could be the mother of all short squeezes. And the reason I say that, our short squeeze chart list, if I pull this up in summary form here, when we put this together, we put it in order. You can see the numbering 1 through 72. We put it in order of the short percentage of float. And you can see GameStop. I didn't even know this was possible. And I'm still not sure that it's possible that you can have more than 100% of your short or your float shorted. I had never heard of that until GameStop did it. I always thought, 40, 50% is getting crazy high, because not only do you have the regular owners of these stocks, but then you've got all these folks that are borrowing those shares and selling them. So it's like with GameStop, let's say there's, 100 million, I don't even know how many shares are out there, but let's say there's 100 million shares. There's not that many, I don't think. Maybe there's 10 million. So let's say there's 10 million shares out there. Well, we now have folks that not only are there 10 million shares that are in the float, but we've got another 10,175,000 or whatever shares that have been shorted. They've been borrowed. They have to be bought back at some point. So when GME starts to break out, if you shorted this stock at $5 and it goes to 11, let's say you put 10 grand in, you're down 10 grand now. If you cover right now, you pay 20 grand. What if GME goes to, 12 and a half this week? Now it's 25 grand you have to pay. It becomes very emotional. And at some point, you just have to say, I can't take this pain anymore. I'm buying. I gotta cover my shares. And that's what a short squeeze is all about. It doesn't happen on stocks that have very little short interest. It happens on these high short interest stocks. And so I always put the percentage in the name of the stock. And the reason I do this is when you take a look, and I was planning on doing this a little bit later, and I'll probably do it again, but if you take a look just at yesterday's action and pull up the percentage change, you can see which stocks on this list did well, and I can quickly look over here and see how big the short interest is. Here's the stock that went up more than 10% yesterday, and it's got 53% of its float short. A lot of people got to squeeze out that door at some point. Now, would I just buy it because it's got 53% short? No, I want to see what it looks like on the chart. So I'd pull the chart up and see, well, it's trying to break back up above that 20-day moving average. It had a huge move once before with big volume. The volume started to pick back up again. I don't know if I'd be ready to jump in just yet, but it's probably one I'd keep on my radar. All right. So there are a lot of different things to do with it, but the key here is, like I said, we do all the research, we put these chart lists together, and just to give you an example of what we do, even if you're not a member at Earnings Beats, we're going to make sure you get a copy of this chart list. And if you're an extra pro member, like I said earlier, you can download it right into your account. All you do, you'll click on a link we give you and type in a password. That'll get you the chart list, and then you can save it right into your account. All right, so that's the, at least one of the examples, I would say, of how you can profit from having this chart list and just watching. So that GME example was a perfect example. On September 11th, here's another one, Workhorse Group. I mean, this thing made a huge breakout. Went straight up. I mean, you can look at the volume back in June on this push to the upside. Then it's consolidated. A lot of folks betting against the stock, saying, it's gone too far. Well, when it made this breakout above 21, I want to show you how fast it moved up 30%. So when it broke up above 21 right here, it hit 31 in less than 2 weeks. And the volume, very heavy on the way up. Now, it pulled back. Where did it pull back to? Right the area that it broke out from. Friday, it was up 12%, bouncing off of support. I mean, these are the stocks on this chart list that I would be most interested in. Not the ones that are still, trending lower. They may go on lower and lower forever, for a while. Maybe they go bankrupt. I don't know. A lot of people betting against them. Again, that's not always a bullish thing. It's a bullish thing when we start to see breakouts. And everyone's got to get out of that packed room through that one little door in the corner. That's when the volume picks up and the price, it's a demand and supply. All of a sudden you're starting to see breakouts. You're not going to have as many sellers. They're excited. The stock's going up. The short sellers, though, are the ones that are going to be emotionally pained. And those are the ones that are going to be coming in to buy and drive the stock higher. So that's why you get these huge moves to the upside. All right, so some other recent examples. Now, I wrote back in Chart Watchers in December of 2019 about Tesla. And if you go back right here, and actually it was right in here, see where, well, this was pre-split. It was, I think, 400 that it needed to get through, which is about $80 a share since they split 5 for 1. So it's really $80 a share. So if we pull up a longer term weekly chart and we go back here, you see these highs, they came in at about $80 a share. When we broke out right here, now Tesla didn't have a particularly high percentage of float because they had a huge float. What they did have, though, was the highest dollar volume by miles on the short side. So if you took all the short shares and multiplied it times the price, that's the dollar short volume. And Tesla at one point, I think, was like, 16, $20 billion worth of short. I mean, the short volume was crazy high. The next highest I think that I saw at that time was like maybe 3 billion. I mean, Tesla was 5 times higher than any other company in terms of the amount of money that was being bet against this company. And so when it finally broke out here in December, I think I wrote the article December 20th, December 21st, I don't know what it was. But I wrote that, hey, this thing is breaking out and you want to be aware. I think the short percentage of float might have been around 20% back then, because I may have even mentioned that in the article. But after it made this big move, the short percentage of float went down. But there were still a lot of folks, when we got this pullback, a lot of folks betting against Tesla still. And I think a lot of this move was helped and aided by shorts having to cover. Imagine borrowing shares. And every time Tesla went up, $50. I mean, again, this is after split. I mean, we had some huge days pre-split, and as a result, there were some weeks where Tesla was going up, 15, 20, 25%, maybe more. If you're shorting, you're losing that, and it's just becoming unlimited. I mean, it's just taking off. And so shorts have to cover. So look at this. I mean, this has been one of the biggest short squeezes. There's still a lot of people that bet against Tesla, but from a percentage of float standpoint, the numbers are much, much lower than it used to be. And with good reason. I mean, they couldn't take it anymore. The pain was too great. You have to eventually cover. So anyway, so that's Tesla. How about another one? This was back in early April. I really liked Peloton. I still like Peloton. I mean, you talk about a stock that, I'm gonna pull up a daily chart. You talk about a stock that's benefited from this new paradigm shift. People, at home more often, exercising at home, many gyms still not open around the country. I mean, Peloton has just exploded. You talk about a company just being in the right place at the right time. I mean, this was already a service, but a lot of people had gym memberships, didn't really think about Peloton, maybe thought it was too expensive. But we got a younger generation that's very interested in they're very health conscious. I think even, folks in my demographic are, trying to do things to be healthier and so forth. And Peloton just is in the sweet spot, being able to exercise in a room with thousands of people, you're competing against, or maybe you're competing against yourself. But to be able to get into shape and do it in the, privacy of your own home, a lot of people doing this. And I would imagine Peloton's going to come out with many different products and strategies and so forth. I think this is launching the company. So this is a real beneficiary of this paradigm shift. But Peloton, this was back April 1st. April 1st, I was on Stock Charts TV for their first episode of The Pitch. It was actually kind of like a pilot. And then it went so well and it was so well received that they started doing this pitch every month since then. So they do it once a month. But on The Pitch, it was me, Mary Ellen McGonigal, who used to be on Market Watchers Live with me on Fridays when I used to do the show over at Stock Charts. And then Grayson Rose, who's the business manager at Stock Charts. And if you've been following me, when I first went over to Stock Charts, when I was a senior technical analyst there for 4.5 years, and I started doing webinars. Grayson was one of the first people that hosted my webinar for me. So really gotten close to Grayson over the years. And he's really super bright. I wish I had been as smart as he, at his age, I wish I knew as much as he did about the market. But anyway, It was Mary Ellen Grayson and me on that show. And we had to provide 5 stocks that we liked. And I went with the whole pandemic theme. And so some of the stocks, I mean, I remember I had Peloton, I had Zoom, I had, believe it or not, Wingstop. Let me show you this. This is another one that I think was heavily shorted for a while, not so much anymore. But Wingstop, now this was back in April here. And so this was right at the beginning of April. Wingstop was 80, now it's 135. So it's done really well. But my whole point here is I was looking for stocks I thought would benefit from the pandemic. And so Peloton was one. And when I brought up Peloton back in April, I'd have to go back and listen to the show now to double check it. But I believe that their short percentage of float at the time was like 47%. So again, one of those numbers near 50%, which is just crazy. And so if you like the stock and it's starting to show better technicals and it's trading above the 20 then crosses the 50, and look at what this stock has done. Imagine how many shorts have had to cover. Look at the volume here. You think that wasn't a short squeeze? $30 to $46 in about 4 or 5 trading days? That is a short squeeze. That is being short the stock and panicking. Literally trying to climb over top of people in that room, trying to get out that quarter, trying to get out that door in the corner. That's the analogy there. But it's continued to be a great performer. Like I said, just because the stock's heavily shorted doesn't mean the market's going to get it right. A lot of those hedge funds have to cover because they get it wrong. They may have been right about Peloton, but all of a sudden we got the pandemic and Peloton exploded. So market conditions changed, the environment changed, Peloton took full advantage, and those shorts got squeezed and had to keep buying along with everyone else as Peloton's earnings and revenues have exploded to the upside. Some people might think I'm crazy, but there's a reason why Peloton's leading the market still. And I believe it's because they're going to continue to report some really strong numbers. But Peloton was another example. I'm going to go through these others pretty quick, but Ollie's, I wrote about it. I don't remember. I think it was when it was 70 something. It was probably like right in here sometime. It had cleared this level, pulled back, and started to move. As it kept going up, look at the volume picking up. Once again, short squeeze. Now, I haven't looked lately to see what the short percentage is. Right now, I don't like it because it's trading below the 20, which is below the 50. Maybe, there's reason to be on the short side at this point. If volume comes in and it moves back through the 20, you got to be careful again. If it's heavily shorted, again, I'd have to go in and double check where that one currently sits. Another one, this one hasn't made quite the move, but Charter Communications was one that I gave. I think it was, I don't know, maybe back in here, June, July. I don't remember exactly. Actually, I think it might have been back right in here, or maybe on this breakout as the volume started picking up. Probably was the end of May. I probably wrote one of my blogs at stock charts, but you can see it actually went back down for the next month. I probably would have gotten stopped out if I owned it. And actually, I think I did own this one. I may have gotten stopped out of this one back then. But anyway, the stock ended up making the breakout. Hasn't seen the huge volume. So I don't know that I would call this a really great short squeeze. We should see the volume really exploding if shorts are heading for the exits and droves. So maybe that one's not as good an example, but this is a good one. How about GoGo? Talk about GoGo. This one got up and went. $8.99. It's trading now. That's just pulling back to the 20-day. This stock was up near $12. When it broke, look at the tops coming in here between $3.50, $4. When it went through $4, if you're shorting, look at the volume pickup. And then it kind of put in a little bit of a bull flag and then broke out again. Look at the volume here. Look at the volume compared to any other time. Shorts had to cover. And then you know what? Once the shorts start covering and you're breaking out, you're setting new highs, then you got your day traders jumping in, driving it higher, more and more momentum. And then more shorts are covering. And that's how you get these big moves to the upside. So go. I mean, as long as it holds that 20-day moving average, I mean, I think this thing could shoot right back up to 11. But there's no doubt that many shorts have gone through that little door in the corner. They've squeezed themselves right out of the stock. All right, so those are some recent examples. Now I want to go into some current candidates. And, there's a lot of different ways to do this. And I'll show you using the chart list how you can maybe zero in on some of the better looking candidates. But I'm just going to go through, and Workhorse I already mentioned. But what I do is when I'm looking at them, I pull it up in relative. I want to look at the relative chart. The other thing I want to do is, I think I might be in, I'm in my other account. That's why I don't have the choices here. Well, there's the relative chart. I am going to change the RSI to accumulation distribution. That's the main difference. But you can see now Workhorse got a surge in its AD line, went sideways while it was consolidating. And now you can see the stock's being accumulated. I think that as long as the stock holds this breakout level around $20, $21, I would expect it to go higher. Now, is it for everyone? This again gets back to one of the questions I said one of the things I pointed out at the beginning, why we don't like to really issue trade alerts. Somebody who's aggressive, and understands the risks and is willing to take the risks that you might lose 15, 20% on this stock pretty quickly, it might be worth it when you realize that you could make 50% pretty quickly. I mean, we got down to $20. If it just gets back up to its recent high at 30, that's a 50% move. Some people are willing to take, 10, 15, 20% risk if they think they got a good shot at making 50. Others, if they think I might lose 15% by tomorrow, they want no part of a trade like that. It's not their style. So you've got to understand that if you're going to trade these short squeeze candidates, you got to have a little bit more of a risky mindset. You got to have a much higher tolerance of risk. If you're managing fixed income, and you really can't afford to lose your principal, you're living off this, I would not be trading short squeeze stocks. That's really not the type of stocks that I would be thinking about. The strong earnings chart list, absolutely. If you like to trade, and then within that chart list, you can look for defensive stocks. Maybe stocks on that chart list that are consumer staples or something. That maybe pay a dividend and aren't going to drop, more than a couple percent in a day. Even on a bad day, that makes more sense. But we don't know what all of our members do. We don't know what your risk profile is. So again, we give you the information, we give you the research, and then you have to look inside yourself and say, hey, I like trading these high risk trades, and you know what? I'm young, so if I lose, then so what? So be it. I'm going to take a chance. Or you might be older and you have a nice nest egg stashed away, and you already have your retirement tucked away, and this is just fun money. Everybody approaches the market different, and really important to understand who you are when you're investing. Anyway, Workhorse, let me go through some of these others. Wayfair, believe it or not, still a very heavily shorted stock. I don't understand why. I mean, the stock, when it broke above 240, look at the volume coming in. There's no doubt that was a short squeeze. I think Wayfair, again, is kind of like Peloton. Just the pandemic fell in their lap. Online shopping. Folks, a lot of the malls were closed down for a while. Anybody wanting to buy anything needed to go to these online places, the Amazons, the Wayfairs, whatever maybe there's some specialty online retailers and so forth that you could go to. But I've bought from Wayfair. I never shopped online, but I have bought from Wayfair. And they send me emails all the time trying to get me to go back and buy some more stuff. They haven't been very successful with that just yet, but they probably will. But anyway, I like Wayfair. I mean, we came down below the 50-day. A lot of people look at the 50-day and think, oh my gosh, that's horrible. We're below the 50-day. I look at it as a secondary indicator. For me, it's more about price support. Look at the double top breakout from 230. In fact, I believe during the selling back here, I even talked, maybe I wrote in the daily market report, maybe it was on a show. I talk about the market in so many places, I can't remember where it is. But I remember talking about Wayfair, saying that if you wanted to get into a stock like Wayfair, buy it on weakness. And I'm pretty sure I said it. I thought it could go back down to the 230s, which was the double top. That was the area we broke out from and hadn't revisited. And that long tail and that hammer right there, we actually got into the 230s. 2 weeks later, maybe 3 weeks later, we're back at 293. So if you miss out on a run, when the market pulls back, use the weakness to buy a leader. And when you look at, you want to know if it looks like a leader. Well, if all four of these bottom panels, if home improvement's going higher, Wayfair versus home improvement's going higher, Wayfair versus the S&P is going higher, and home improvement versus the S&P is going higher, that is the definition of a leading stock in a leading industry group. This is what I try to get in our portfolios. When you've got 10 stocks that look like this, yeah, some of them will probably break down in the next quarter, but the ones that keep going tend to carry the portfolio. So I don't know which of the 10 are going to keep going with the model portfolio. Maybe we've just been lucky, but we've had a lot of the 10 continue to outperform. And that's why our model portfolio is absolutely through the roof right now. In fact, I just updated it. I'll show you this real quick. This is the portfolio chart. We started this back in on November 19th of 2018. And so from there, we start off with a value of 100. And then we keep an Excel spreadsheet tracking performance. And each day, the information is added using the user-defined index at Stock Charts. And so this is, if you had bought the model portfolio from day one and you just followed exactly what we were doing, this model portfolio, if you put 100 grand in here, your 100 grand would be worth $242,880 right now. It would be up 142.88%. The S&P 500, if you had put 100,000 in there, you'd have 122,590. You're up 22%. Quite a difference. And it's just, again, and does the model portfolio go down? I mean, if you get in at the wrong time, February 19th, imagine announcing our portfolios on February 19th, right before the 100-year pandemic hits. Look at the S&P 500 getting absolutely crushed. Look at the model portfolio. I mean, it wasn't like we had these stocks that weren't hit by the pandemic. They went down, but we came rallying right back. In fact, when we've been hit, this was the fourth quarter in that December 2018 pullback sell-off because of the trade war. But notice when we broke to a new high. See the December high and the December high? Model portfolio breaks out at the end of January. The S&P doesn't break out until the end of February. Why? Because when the market sells off and money starts rotating back into the market, where do you think it goes? I can tell you where it goes. It goes into leaders. It goes into leading stocks. When money is ready to be put back to work, first thing portfolio managers look for is Apple, Tesla, Amazon. Those types of leaders, those are the ones that are going to get the money. And so they outperform the S&P 500. So there you can see we broke out. How about the big move here in February? It took all the way until August for the S&P 500 to break out. Our model portfolio broke back out to a new high in May. There was a lot of good reasons there, but I won't get into all that. But the whole point here is the model portfolio. If you stick with leading stocks and leading industry groups, that's where I think you're going to do extremely well. So Wayfair kind of fits that category. All right, a few other current stocks that I think are still great short squeeze candidates. Oops, how'd that happen? Why is that happening? All right, bear with me here. Let's try this again. So Jinko Solar. This stock right now, heavily shorted. Look at the volume on this breakout right here. I think I talked about this one on my show, saying that if we could get through this top over here, which I think was $29, it could really move. Well, that was, let's see, that would have been back on Wednesday. It was probably my Wednesday show at Earnings Beats. So if you went back and reviewed my show on Wednesday, Trading Places Live, we have the recording on our website. I'm pretty sure it was like at 29 at that point or very close. And so I was looking to see if we were going to make that breakout. Well, we did. Look at the volume. What happened? All those short squeeze, all those short traders had to try and squeeze out of that room, out that door in the corner. That's what did this. All the volume coming in, sending the price. Once it got through 29, it finished 35. That's $6.50. That's 20% in 2 days. Short squeeze, massive volume, breaking out. This is what you want to see. Here's one that, hasn't really done that much, but it's starting to show some signs to me. Look at the move up here. See all these tops? $10. Well, we got up to 12 and a half almost. Pulled back, put in that reversing candle right there on the 20-day and also testing the breakout level. And then we were up 5.5% on Friday. If we get back up through $12 on a closing basis, watch that volume, because this is another one. If you're sitting there on the short side, you've watched this stock now for the last month go from 7 and change to 11 and a quarter. That's 40% in a month. How much longer are you going to hold it? What if it gets to 12.50? What if it gets to 13 and the volume starts to explode? You've shorted at $7 or $7.50, whatever, and you're just watching your money just literally just going up in flames as price keeps going up. A lot of, we've done surveys. 90% of our members, when we did surveys in the past, and we haven't done it for a long time, but 90% of our members didn't short. And that's fine. I don't short. I rarely short. We have to be in I have to feel we are in a secular bear market. I shorted back in 2007, 2008, and I usually did it using the inverse ETFs. I tried not to do it with individual stocks, because with my luck, I'd get in the wrong stock. Market would collapse and I'd be in the one stock that would go higher. So if I really thought the market overall was going down, then I'd park some of my money in those inverse ETFs that actually go up when the market goes down. So I'm not really into shorting. So I understand. I think a lot of people not only don't short, but they don't understand the concept. And so hopefully today is helping a little bit if you're in that category. But those that do short, there's just some people that carry a very negative mindset about the market at all times. Always believe we're overpriced. It doesn't matter. They're perma bears. And some might call me a perma bull. I'm not a perma bull. I just read what the charts tell me. I've been bearish. I was bearish in 2007 to 2009. How can you be bullish in the midst of all that? Now, there were times where it looked like the market might rebound, but you have to recognize these secular bear markets versus secular bull markets. I think we're in a secular bull market. It's going to last the next 10 years or more, with cyclical bear markets along the way, like the one we just saw back in March. They tend to be very short-lived. We saw it again. We saw fourth quarter of 2018 with the trade war, 20% drop in 3 months on the S&P 500. Back in March, in 4 weeks, maybe 4 or 5 weeks, we saw the S&P 500 drop 35%, and it was over. We've been rallying ever since. That's a cyclical bear market in a secular bull. That's what they look like. I'm not making it up. Go back and look at history. Actually, on Monday, we're going to be doing a fourth quarter market outlook, and I'm going to talk a lot about the big picture in the secular bull market. That's going to be for our members only. So if you're not a member, you might think about that 30-day trial that we have. No cost, $7, we refund it to you. Anyhow, getting back to this, you can see that Smile Direct Club breaks out above a key level, volume explodes, we pull back, we hold it. This is starting to act like an uptrending stock. Another breakout, and you're going to have shorts wondering what the heck we're going to do. And when they start buying, you're going to see this thing explode up to 15 and a half. So if I saw volume coming in and this stock breaking above 12 and a quarter, 12 and a half, I'd be looking for 15 and a half on it to test this level. And then we'll go from there. Breaks out above that level, I think there's going to be a lot of shorts trying to squeeze out that door. I'll give you maybe two more here. I know one that I've been talking about a lot with members has been Bed Bath & Beyond. And check this out. Look at the volume pickup on this breakout above $13. Last couple of days, still going higher. Another 4% on Friday. Volume heavier than normal. This is broken out. I think it's running up here, probably that 17 level. And then the last one. This has been kind of an interesting, because this has been all over the place. This is the big five. You can see the gap up here. Look at the volume. Pulls back. Then it breaks out. Volume starts picking up again. Another big volume gap up. Another big volume move to the upside. Now it's sideways consolidating. It's got really good support, 5 1/4 to 5 1/2. So this is one maybe just kind of keep on. I don't know if I would buy it here. If I did, got to be willing to take some risk. And I think if the stock were to close back below, say 5, I definitely would be out. Maybe 5.25. So you got to give it some room to the downside. But if it explodes to the upside, getting back just to where we were would be more than $2.50 from where we are now, which is $2.50. That's 40%. And if we manage to break out above that prior high, who knows how high we go. So again, these short squeeze ChartList stocks, you've got to have a mindset of being, understanding that there's a lot more risk involved. You got a lot of people betting against you. If you're going to go long these stocks, you have to understand that these are heavily shorted stocks. Many of them will go lower. It's the ones that are starting to show relative strength, the ones that are showing the heavier volume and uptrends. Those are the ones we're interested in. The other 80%, ignore them. Wait, and I'll show you in a minute how we can, how we can see them evolving into stronger stocks. I'll show you that in a minute. Let's see, maybe one more on the list. Current candidates. I'm trying to think what else, what other ones we have out there right now. Stitch Fix was one I recently talked about. Now, this one pulled back with earnings. I haven't been looking at it. Yeah, I was watching 26, and it did close below 26, which made me a little nervous. But I will say this is a stock that's heavily shorted. If I go into the short squeeze chart list, I think it's like 11th. Yeah, number 11 on the list. 43.58% as of September 15th. 43.58% of its float was short. Now, it made the breakout, and actually, I like this stock, and I was looking for the breakout. The problem was it made the breakout on the day it was going to report earnings. So just jumping in blindly without, holding into an earnings report is definitely kind of scary. But I will say this: if this stock with its earnings report, and they reported earnings per share that was below expectations, so it was not a good report. I think their revenues may have come in ahead of expectations, but their earnings were lower. But if we come up with that bad news and we can somehow hold on to this 50-day and go back up and break above 31, 32, I think you're going to see the volume explode, and you're going to have a bunch of traders waiting to pile out of that exit in the corner, out of that room, because the room's going to be on fire. And so that's, again, patience. You got to have patience. We got to wait. I would not buy Stitch Fix at this point, hoping that it gets through 31 or 32. With these stocks, you don't need to do that. I mean, yeah, it would be great if you buy it at 26 and it goes to 31 and breaks out. I mean, GameStop, when it pulled back after earnings, it's been great if you got it there. But if you got it over 8 and the stock's over 10 now in 2 weeks, you still can make a lot of money on these stocks. And GameStop could have a lot higher to go, by the way. When I wrote about that in the EB Digest, I said this could be the mother of all short squeezes. And someone came out, I forget who it was, but they announced that they were acquiring a 9% interest in the company. And I think anybody who thought the company was going out of business probably had to reevaluate at that point. And that's kind of what started this upward explosion on the stock. All right. So now let's analyze. Last 2 areas, and we'll be done here. Let's analyze the short squeeze chart list. So when I say analyze, there's a couple of different things that we can do. We can, I can show it to you in summary form, which is how I view a lot of my chart lists, or we can run a scan against it. So I'm going to show it first as I did earlier, in summary form. So when you're looking at this, right now it's in order of the most heavily shorted. So that's a good place to start. And you can just scroll, just hover above the symbol over here, and it'll give you the little mini chart. I mean, so I can quickly look at that and say, oh my gosh, we got a short squeeze underway on GME. Now, SPCE, which is Virgin Galactic, we did have this breakout. Let me pull up that chart. We did have this breakout right here. Volume exploded. Did it hold? No, and it's been trending lower again. So if you got in on this breakout at 21 and said, I'm just going to hold this thing till whenever, you got to have your stops in play because you don't want to get stuck holding a short squeeze stock that rolls back over. So taking some profits on the way up, probably not a bad strategy. And if you do hold thinking you're going to, make a 400% on the stock, just make sure you keep your stop in play on the way back down because it shouldn't come back down and break the breakout level. That would be a not so good sign. The other thing that you want to make sure is that a stock, and one of the things I look for is that you want to make sure the relative strength is there. So when we broke out here back in July, look at the relative strength versus aerospace. We're breaking out. But you have to be conscious of a couple things. Number one, aerospace is one of the worst areas in the stock market right now. So yeah, maybe we did get a short squeeze, but you've got to be prepared to take that loss if it turns, rolls over on you because you're not in a great area. Also, look at the relative strength begin to fade again. Now, if all of a sudden aerospace starts to turn higher relative to the S&P 500 and Virgin Galactic starts to turn higher relative to aerospace, and we start to see technical improvement on the chart where we're breaking above the 20, maybe getting back up above these recent highs, we see the volume picking up, then it becomes a short squeeze candidate. Right now, looking at this chart, I have no interest in the stock right now, zero. I don't care how heavily shorted it is. I don't care if it's shorted 65%. Maybe it's being shorted at 65% because the stock's got a lot of issues. People know that they have issues, and they just don't believe in this stock. Until those people are forced to begin buying, stock's not going to do much. So stay away. All right, so this is one way to look at it. We've already done the homework for you. We got it all set up for you. When you download this chart list, you already have all of this set up in your account. Now, another thing you can do is, I know that specialty retailers are a great place to look in the market. I mean, that's been a pretty nice area of the market. So if I sort this by industry group, I could go down here to specialty retailers, and here they are. Now, the other thing I can do is if I short by scooters first and then sort by industry group, when I go down to the specialty retailers, notice they're in order of scooters. So all of a sudden, look at all these specialty retailers. Almost every one of them are lighting up the shorts right now. Why? Because money is rotating into specialty retail. Let me just pull the specialty retail. Actually, I'll show you, I mentioned earlier the industry group relative strength chart list. Let me show you what we do with this. Here are all the industry groups in here. I've got them broken down in order by all of them in technology first. So 001 is technology. And then I've got this broken down further from 1 to 7. There's 7 industry groups within the technology sector. Then 002 is consumer discretionary. And then I number the 20 industry groups, 1 to 20 within that 002 group, 003, and so forth. So you get an idea. That's how this thing is set up. But what you can do is view all and put it in summary form. And if you want to find an area that's starting to really perform well, go over here and look. Well, first, let's set this up based on percentage. So I wrote in a daily market report yesterday, one of the things I said was that the cruise lines were having such a big day. Well, this is the chart. The first thing I looked at was the fact that recreational services was killing the S&P 500 yesterday. Gambling stocks killed it yesterday. Hotels, autos, computer hardware, delivery services, aerospace, renewable energy. I can go right down this list and I can see, the groups that are leading the market. So if you're thinking about the short squeeze, you might think, okay, well, what about over the last week, what's been doing well? Footwear. So I could go back in here and see if there are any footwear stocks, which I'm pretty sure there aren't. Okay, no footwear stocks, heavily shorted. So no big deal. Computer hardware, broadline retail. Here, let's see. I was looking to see if specialty retail had a good week last week. Maybe not as good as I thought. There it is. So it clearly outperformed the S&P 500. But it ranks, I don't know, what is that? Maybe close to 20th on the list, maybe a little less than that, out of 104. How about the last month? Now, we've had kind of a rough market through the consolidation, and also things are kind of turned upside down a little bit in the last month. But let's go back. How about 6 months? Last 6 months, there's your broadline retailers. They rank 11th on the list. There's specialty retailers, 13th out of 104 groups. So outperformance. This doesn't mean relative, or this doesn't mean that the specialty retail is up 14% in 6 months. This means that it's outperforming the S&P 500 by 14%. Autos has been the best area. And of course, Tesla has been one of the biggest reasons why. But you've got autos, you've got recreational products, delivery services, renewable energy, home builders, computer hardware. Aluminum has done well, but we haven't really focused too much on materials. Non-durable household, home improvement, broadline retail, footwear, specialty retail, buildings, building materials, and so forth. There's internet, toys. These right here, you're going to find a lot of our portfolio stocks in those groups. But the other thing you can do is say, okay, recreational products has been a great area in the market. I think under the 1 month or 3 months, I think that was doing pretty well. Where's that RP? Oh, maybe it's not as good as I thought. How about the last week, this past week? There's recreational products. So last week it was 8th, outperformed the S&P 500 by 3%, 3 percentage points in just the last week. So if you know that recreational products are hot, go into the short squeeze and look, see if are there any recreational products. No, unfortunately, no recreational services. My whole point is when you find a hot group, look at the space. Look at all of these scooter scores. These were all candidates for short squeezes. And then you could even look and see, okay, GameStop, 101%. That's their short percentage of float. That's crazy. But Bed Bath & Beyond, which I just mentioned to you, is 61%. You know, these are the types of stocks that can absolutely explode. And it's not necessarily because they're great companies. It's because of the short-term inefficiencies I talked about at the open of this webinar. Short-term inefficiencies. Short selling, short squeezes. Doesn't mean GameStop. You know, GameStop's up 100% in the last 4 weeks. Does that mean that GameStop's the best company out there on the market? No. It's a short-term market inefficiency. It broke out. Everybody's betting against it, so they have to squeeze out that exit in the corner. And that's what's causing this huge move to the upside. You've got, as a trader, you know, if you're a long-term buy and holder, I would not own GameStop. I just wouldn't. I don't want a stock that everybody's betting against. Maybe they have good reason for it. And if you've been holding it for the last 2 years, you've probably been losing a lot of money while the market's been going up. Hasn't been a great investment. Short term, it's been great because short squeeze. You got some good news. An investor. Folks are being squeezed out. Short-term market inefficiency. All right, so that's one way to look at this. You know, by industry group, using the other chart list that we provide to help you find some of the strongest areas. You know, if apparel retail all of a sudden catches fire, I mean, we already know Signet, SIG, is doing very well. Scooters 94, 31% of its float is short. If apparel retailers break out, we start seeing money rotate into that group. A stock like this could do a lot better. Maybe Shoe Carnival with a scooter at 80, maybe it's getting close to a breakout. Pull that chart up. Well, it went right up to the top here. It pulls back to the 20-day. If it goes back through 40 and starts to, you know, setting 52-week highs, this stock gapped down with its earnings right here. And look at the huge buying after that sell-off, you know, at the open. That's serious accumulation to the upside. And I bet that the AD line here is probably going through the roof right now based on just looking at those two candlesticks. Yep, look at that. Explosion in accumulation. If this stock goes back up and breaks above $40, I would want to own it as a trader. Everybody in that room is going to be trying to get out that little door in the corner. I think we'll send the stock screaming higher. And also Shoe Carnival, even though it says apparel retailers, it's kind of related footwear. And we just talked about footwear being one of the best groups. So anyway, that's how you can start looking at the market without just looking at the chart or just looking at earnings per, price earnings ratio. That's all great, but you need to combine it all. I remember getting so many emails about Amazon when Amazon kept going up and they kept reporting losses. How can anybody buy Amazon? This is the most overpriced stock in the market. What are those people saying today? I get emails now about Tesla. It's crazy. There's no way this company's worth what it, is priced at. I say we'll see. I believe the market's pricing it because of future growth and because of their prospects and because growth stocks are in favor and Tesla is blowing their earnings per share out of the water. So their future growth rate is being adjusted higher. That's why stocks get valued the way they do. Anyhow, so that's one way to evaluate and analyze the short squeeze chart list by pulling up in summary form and just manipulating all this data. And if you pull yours up in summary form and you're not seeing all of this, look at this columns. Make sure you check off what you want to see. Because I'll get invariably an email from someone that'll say, I don't know how you got the industry groups on your summary. Well, you just got to make sure that it's checked off. If I take it off, it'll be gone. Oh, I took off the scooter. Took off the scooter in the industry group. So now I'm just left with the sector. But come right back and you can just put it on industry group, scooter, and there you have it. So you can set it up and customize it however you want. The other thing that you can do. So let's say that, maybe we don't have a high scooter, but we got to, over the last 3 weeks, we're wondering if some of these stocks have really seen a jump in their scooter. Now, we could put the scooter on their chart and just go by all the charts one by one, or we could just write a scan. And so let's do a new scan. And I'm not really worried. It's the stock, the volume. I'm going to run it against the short squeeze chart list. So this doesn't even need to be here. I'm just going to get rid of all this. So what I'm going to do is I'm going to say, okay, give me the scooter, any stock that has a scooter currently above, and I'm just, you can put anything you want. I'm just going to say, give me any scooters that are greater than 70. And then I'm going to go back to the scooter. I'm going to add, give me any scooter. We said 3 weeks ago. So in trading terms, that's 15 days, 15 trading days. So 15 days ago, the scooter was less than 60. So what we're doing is we're just saying, okay, 3 weeks ago when all this weakness started, the scooter was less than 60. But now, market's starting to turn back up again. And let's say the scooter's risen to 70. That's just an improvement in relative strength using that formula. Now, what I can also then do is go down to our chart lists and I can say, give me my short squeeze chart list and add it. So now what it's going to do is it's now only going to look at my short squeeze chart list and it's going to see if any of those stocks meet this criteria. I haven't run this, so I have no idea whether this is going to work or not. Check syntax, everything's good, run scan. 6 of them. So 6 out of that 72 meet that below 60 3 weeks ago and now above 70. And here are the scooters. Look at INO. It's gone to 95. OPK has gone to 92. That's a huge drop, huge jump from below 60 to 95. Might want to look at that chart. Well, look at what has happened since the beginning of September. Huge move up above the 20, came back down, tested the 20. Another breakout above 19 or so. And there are going to be some shorts feeling some pain because this stock was $9, less than $9 beginning of the month. You get back through 19 and anybody on the short side just saw their, if they had if they had, say $10,000 on the short side, then now to cover, it's going to cost them $20,000 on a potential breakout. And if they decide, well, I'm just going to let it go and see if it gets up here to the 27 level, that's a triple. If it gets up there, now they're 10,000 sale price. They now have to pay 30,000 to, to get those shares so that they can return them to the broker. See how this works? We're used to, most of us that don't short are used to feeling that pain on stocks that go down. But if you put 10,000 in on the long side, the most you can ever lose is 10,000. I mean, if you invest $10,000, that's your risk. On the short side, if you sell for 10,000, you have to buy back. You have unlimited risk. So when these stocks start making these moves, that's why you see them move up very, very fast. I mean, look at this breakout here. The stock was at $6. 4 days later, it was at 20. Look at the volume. Everybody squeezing out that door in the corner. Look at back here in June. All these tops. Here was your breakout. Look at the volume. $20. 3 days later, it was almost 35. 75% move. Was it a great investment to hold it? No. These are trading candidates. Short-term market inefficiency. That's what you should be thinking about. So anyway, that was just a way of running a scan. I mean, you can come up creatively with any kind of scan against this chart list, anything that you wanted to do. But that would be, a way to begin to, find stocks within this chart list. I mean, the chart list itself is, let's see if I can go back to that. The chart list itself has 72 stocks. So I literally could, go into the first one and look at it and then scroll. I could do this and just go through and see what looks appealing to me. Or I can just have a scan and save it that I run against this every day or maybe every week just to see what's happening. The stock charts is powerful. I'm telling you, if you take our research and you combine it with the tools and the power of stock charts, you're going to have better information, in my opinion, than the biggest Wall Street firms. I believe that. None of the Wall Street firms are performing and doing what we're doing with our portfolios. I'm not aware of any of them doing what we're doing. It's just our research and combining it with stock charts tools. So we will allow you to download this chart list. We'll make sure we get in touch with you. I think what we'll do, and I'll be talking to John and Abby and the rest of our team at Earnings Beats, but what we'll probably do is send you a link and a password in one of the Earnings Beats Digest newsletters. One of the articles that's coming up probably Monday, or maybe it'll just be maybe it'll come out tomorrow or later. I don't know, maybe tomorrow. But anybody who's in our community, we want you to have this chart list. And again, we update it every month. So if you really like this is part of our normal service. We have so many parts of our service that pays for itself. But this is just one piece. And if you'd like to, get this, we're going to give it to you to start. But if you want to stay updated on this stuff, you can either do the research yourself or you can let us be your research department. And that's kind of what an educational department. I mean, there's a lot. It's not just us doing the work and handing it to you. I mean, I do the Trading Places show. I do the blogs. I do the daily market report. We have, weekly portfolio report. We got all the ETF stuff coming out, the big picture chart coming up. Hopefully I'll have it ready on Monday. All of these things that we do, all of our webinars that we do, the market outlook coming up on Monday, our portfolio webinars, Max Payne webinars, dealing with options. There's so much educational content that we have. So we would love for you to try our service if you're new. And we'd also love for you to commit to us for a year if you're currently a member. So again, I'll just go through before I end this, just show you on the webinar special here. You can go into our website, just click on webinar special, see all the things that you get. This does not even include everything. It doesn't include what I just talked about, some new product enhancements that we're going to have dealing with ETFs and that big picture chart list. But if you look down here, it's going to cost you $97 a month. Using this special, which is good through Monday, we'll give you a year plus 1 bonus month for $697. So that's 13 months. And anybody who's on a trial right now, we will give you the rest of your trial. So let's say you just signed up and you're on a 30-day trial. This 13 months will get added to the end of your trial. We're not going to, if you sign up, it's not like you're giving up the rest of your trial. I just want to point that out because that's always a question that comes up. So technically, if you just signed up for a 30-day trial, you're going to get 14 months for this price. But you also get that industry group chart list that I showed you. That is powerful, this right here. And then also on Monday, I'll be announcing that big picture chart list, which will be given out to any annual members as well. All right, I think that is it for me. John, did you have anything to add?
Just a couple quick questions, okay?
Okay.
Why do you use accumulation distribution instead of OBV?
Oh my God, this is well, let me be honest. In normal markets, and actually, I'm here getting some feedback from you, John. So after you ask a question, if you can mute, that would be great. I would let me pull up a chart, and I'm trying to think of a good one. Maybe DocuSign. I'm going to pull up the AD line, and then also the OBV. I like both of them. They're just different. And the reason I like the AD line, I think based on what happened with the pandemic, the AD line told us so much. I was not even somebody who used the AD line on my charts until this year. And now it's almost like it's a paradigm shift for me in terms of how I like my charts going forward. I just learned a lot more about that indicator. But I'm going to bring this up, and I'm going to show you these two with DocuSign, see if this works. Yeah, it works a little bit. Okay, I want back in, let me make this bigger. And we'll shorten the chart just a little bit. Okay, so here we were back in February, March. So we topped February 19th, had this big move down. DocuSign went down with every other stock in the market, right? So the stock market was down 30%. DocuSign was at 92, went down to 66. That's 26 bucks from 92. So it's down 30%. So you might look at this and say, well, market was down 35%. DocuSign is down 30%. It just went along for the ride. It's not anything I should consider. Well, early on back then, we were pointing out stocks like DocuSign that were being accumulated. And the way I knew that was price action was going down. The first move down, many stocks showed the accumulation distribution go down. But the second one, the one in March, and that's the one I refer to as just a panicked. Everybody pushing the sell button at the opening bell. They couldn't take it anymore. We were waking up and Dow futures were down 1,700 one day and 1,000 the next day. And then we'd rally for a day and then we'd be back down 900. And every article you saw, I mean, media is about clickbait. They're trying to get viewers. They're trying to sell ads. And in this day and age of social media, you got so much competition. So the clickbait ads were, the sky is falling. The Great Depression 2.0. I mean, that's what we were dealing with back in March. And so everybody was panicking out. Maybe not everybody, but a lot of folks were panicking out at the opening bell. The difference between the AD line and the OBV is that if a stock went down from the prior day, the OBV doesn't care what happened during the trading day. The OBV looks at where did we finish today? Where did we finish yesterday? If we finished lower today, we're subtracting the volume. So look at March on the OBV going down. The AD line ignores the gap. OBV ignores, what happened during the trading day and only focuses on where you finish each day. The accumulation distribution ignores the gap. And the thing I really like about it is if you're a portfolio manager and you've got 1 million shares of Apple, first of all, congratulations. But if you're trying to get out of stocks, you don't As a portfolio manager, you don't go into your TD Ameritrade account and say, sell a million shares at market. Individuals do that. A lot of folks panic out and they'll go in and they're just like, I can't take the pain anymore. I'm selling just because then I can breathe easy. I can, just put this pain behind me. You got a million shares or 500,000 shares of a stock. You can't just go push the market sell order. First of all, many of those institutions work with market makers. Market makers make a lot of money executing at the best possible price for institutions. They do that by taking advantage of you and me. I mean, I don't know how else to say it. And part of it is, I think back in March, institutions were buying. They were not selling. In 2008, when we had the financial crisis, in September, there was about a 3 or 4 week period. We lost 25% on the S&P 500. During that period, the gap downs accounted for 16% of the drop. Intraday selling accounted for 84% of the drop. In March, from this drop, February 19th to March 23rd, when the S&P hit its final bottom, the gap downs accounted for 91% of the drop. 9% was during the trading day. So the gaps were 91% in March during the pandemic. In the financial crisis, the gap downs were only 16%. Do you see the difference? After the opening bell, back in the financial crisis, we were in a cyclical bear market. Everybody was selling. Institutions were selling, and of course, they have to get out during the trading day. So we saw a lot of these big red candles, filled candles. Look at DocuSign's chart. Do you see, here's a couple of big red candles, but during that panic, do you see any big red candles? I see more gap downs. And actually, I see a lot more hollow candles than filled candles. Even over here, hollow candles. What's a hollow candle? You're closing above the open. We're closing well off the intraday lows. Accumulation distribution, I know this is a long answer to a short question, but I want to make sure everybody understands this. Accumulation distribution looks at where you're finishing relative to where you were during the trading day. So if you finish right in the middle, you'd basically take 0 and multiply it times the volume, and you go nowhere. The AD line just stays flat. Even though, like here, back on, that would have been 10th, 11th. So from the close on the 11th, we had this huge gap down on the 12th. But we didn't go anywhere. We kind of we're right in the middle of the trading action that day. When you look at the AD line on that day, you'll see, looks like maybe a slight move up right here. But look at the OBV going down. OBV only cares about the fact we went down that day. Doesn't care whether there's buying or selling throughout the day. So this was more heavily influenced by, in my opinion, the media and the selling that took place at the open. Everywhere I turned, it didn't matter if it was social media, whether I went to CNBC, went to Bloomberg, there were headlines that the sky was falling. And if you read that enough, you're going to feel like the sky is falling. I literally try to avoid news of all types. And that's the only way I can keep an objective view of everything. I don't like, to sip the Kool-Aid on one side. I don't like to listen to the fear on the other side. I just like to look at the charts. The charts are telling me everything. I follow the earnings reports. I follow the charts. I follow the Fed. Don't fight the Fed. Please don't fight the Fed. The Fed's telling us interest rates are going to stay low for 3 years. I can only tell you what history, what the market does when the rates are historically low. We were in a secular bull market back in the 50s and 60s when interest rates were historically low. We are now in a secular bull market that I think is going to last another decade, because one of the reasons is that interest rates are historically low. Don't fight the Fed. Anyhow, those are the things I follow in the market. But getting back to this accumulation distribution versus OBV, that's the difference. That's why I think the AD line is a better indicator. Now, we don't always go through periods where we have pandemics and lots of gap downs and gap ups. So I think in a normal market, I think they're both probably about the same. And I know, I had this discussion with Arthur Hill from, he was a fellow senior technical analyst with me over at Stock Charts, and Art's a great guy, really good friend. And we've talked about these two indicators, and we both agree that it's nice to have them both going in the same direction. So if you ever see a stock that's going down and you got an AD line and OBV going up, chances are that's probably a good investment. And I say chances are, obviously you got to still look at the charts and everything else, but that's what I would use AD and OBV for. But I believe throughout this pandemic, and even recently when we saw the selling again, kicking back in early September, I just wrote about Tesla this week. And I said, I'm seeing accumulation. I don't care if the stock price is going down. I think the stock's being accumulated heavily. And we saw it coming back up at the end of the week. I believe it's going to break to a new high. I think the stock still has much more room to the upside. Call me crazy. I mean, it's two sides of every market. I might be wrong, but I'm going to have my opinion. And based on the technicals, that's what's going to drive my opinion. All right. Anyway, hopefully that explained it. What else you got, John?
Last question, we'll wrap it up. You mentioned an article about Tesla. Somebody was asking where they might find that.
Okay. Yeah, that's the one I was just referring to. So if you go into articles, there it is. It's actually the most popular article on stock charts right now. I'm guessing. Now that was one. They may have been asking about the one where I talked about it was the short squeeze, and I'll show you that in a minute. So here was the article I just wrote about being accumulated. And look at the AD, and this is a perfect example. AD lines going up, OBV's going up, stock price has been going down. Now, you can just, if you just looked at the stock price, you'd say, oh man, Tesla was at 500. Now, it's at 374, at least as of the date of that article. This is a horrible stock. It's dropped 25% of its market value in the last 3 weeks. And I agree. I mean, if you buy at 500, you probably do think it's the worst stock in the market. I mean, we've all bought stocks at highs before. I've sold a stock at the very low. I've done that multiple times where I can point to it and say, yep, those were the shares I sold. And that's pretty frustrating. But I don't think anybody can deny that Tesla overall is in an uptrend. And the fact that it's been pulling back, I look to see, is it being distributed or is it being accumulated on the pullback? And based on this, I think it's being accumulated. Now, the other article that I wrote about that they may be referring to was in Chart Watchers, and that was back in December of 2019. So if you go into Chart Watchers, any blog, there's a blog archive button here. Click on that. And 2019 in December, and it was in the title. So let me just see if I can. There. Well, no, it wasn't. All right. So Tesla did have 21% of its float short. December 20th, 2019. Here's the Tesla chart. Now, it's showing 400, but remember, we've had a 5-for-1 split. So that was really $80 back then. And now we're sitting at we were at 373. I think we finished Friday at 407 or something. We've had a nice rally at the end of the week. But look at the volume. Same thing I was talking about earlier. Shorts were trying to get out of that exit in the corner, that little door in the corner, and the room was set on fire. And there you go. Everybody's trying to jump all over everybody to get out. And that's what happens in these short squeezes. So that's it. So if we don't have any more questions, I'll go ahead and wrap it up. I do appreciate everybody coming to the event today. And I do want to remind you, Monday, Q4 market outlook. So I'm going to go through many of those big picture charts and start talking about why I believe the stock market's going a lot higher in the Q4. And I know a lot of people disagreed with me back in March. I could go back and show you, I think it was in Chart Watchers on March 13th. The article is either there or Trading Places, but March 13th sticks in my brain. I usually remember dates pretty well. So that day, one of those blog articles I wrote, I said, we are in a secular bull market. And I got emails and people are like, you're just a perma bull. I'm just saying what I see in the market. This AD line was a big part of why I was still making that call. I was not seeing distribution of aggressive stocks. I was seeing accumulation of aggressive stocks. Why in the world would Wall Street be accumulating growth stocks if we were in a bear market? Made no sense. So, and then a big picture chart, which I do, the 100-year S&P 500 chart. I'll definitely talk about that on Monday as well. That really lays out in big picture format how, the 1987 crash, which was horrible while you were in it. I mean, I remember I was really just getting started in investing. I got my butt kicked during that market crash. And I was one of those people who said, man, I don't know if I ever want to invest again. Thankfully, I kept at it and kept, learning more and more about the market. And then I ran into John Murphy and learned about intermarket relationships, and the rest is history. But 1987 was a little blip in a secular bull market that lasted from the 1980s through the 1990s. When you look back, it was horrible at the time, but if you held and just wore blinders and didn't pay attention to it, you didn't even notice it a couple of years later, and you certainly didn't notice it a decade later when the market was way above where we were pre-crash. We're going through the same thing right now, in my opinion. We are reliving 1987. That's what we just went through with the pandemic. A lot of folks don't realize that pandemic from 100 years ago, the Dow Jones, the year that the pandemic broke, and the next year, the Dow Jones went up either 10% and 30% or 30% and 10%. I forget which way it was. But the 2 years of the pandemic, the market went higher. Why? A pandemic is a short-term thing. A secular bear market requires excesses to build long periods of time. In my opinion, we're nowhere near that. But we'll talk a lot more about that on Monday. So be sure, if you haven't already, you can go into our homepage. Everybody will be set up for the Earnings Beats Digest if you're in here, or if you're listening to the recording later on. We'll make sure you get set up for the digest, and you can unsubscribe at any time if you don't want it. And again, there's no credit card required, so it's completely free. But if you do want to check out our service, and I would really encourage you to do so, you get 30 days at no cost, which will include the announcement of our model ETF portfolio, which will be out sometime in October, probably next few weeks. So it would be a great time to join. Anyhow, that's it for me, John. So I just want to thank everybody again for coming in. Have a great rest of your weekend, and we'll be back on Monday. Take care, everybody.